Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest episode of InvesTips. In today's episode, we'll take a look at equity market volatility and understand how we can navigate uncertainty with both clarity and confidence. Joining me today is Manpreet Gill, Chief Investment Officer for Africa, the Middle East and Europe. Welcome, Manpreet. It's really great to have you on the line.
Thanks very much, Steve, for having me again. I think it's a really great time to talk about equity market volatility, given not only how much uncertainties are around us, but also how surprisingly calm markets are.
Yeah, so I guess let's get straight into it. I guess when markets get unpredictable, it's easy for investors to panic or make decisions they're going to regret later. So the best approach I find in times like this is to try and stay calm, which is obviously incredibly difficult to do, and carefully think through both the risks and opportunities, and try and take a probabilistic approach to the outlook before making any decisions. But I think, to do this, I think we really need to understand exactly what risk is and how it can affect our investments. So maybe let's lay some of the groundwork here. Why don't you just walk us through some of the basics when it comes to risks in the stock market?
Sure. No, I think that's a good place to start because I think risk is not always well understood. Now, at a broad level, I think risk is, the chance that as an investor you could lose some or all of the money you've invested. And you can break this concept of risk down into two types. There's systemic and unsystemic risk. Now, the first one, which is unsystemic or what you might call idiosyncratic risk, that comes from events that tend to only impact a specific company or sector. So, for example, you might have a big change in company leadership or issues that are quite unique to that business or sector. It could be performance related. It could be operational as well. Now, these are obviously quite specific risks, and you can lessen them by spreading your investments across different companies and sectors. The other risk, of course, is more systemic. These are risks that affect the whole market and not just a handful of stocks or sectors. So you have, of course, big macroeconomic indicators like growth, inflation, unemployment. These can have an impact across an entire economy. We have geopolitics or policy changes, just as the recent US tariff policy, for example. These, of course, can affect economic growth as a whole and the market as a whole as well. So that's more of an example of systemic risk.
Okay, so let's talk a little bit about investor sentiment, because obviously there's the macro fundamentals, but then stock prices and emotions do move together, probably through different phases. And maybe we can talk about the different phases, such as accumulation, markup, distribution, and markdown. Can you help us understand how each of these market phases impacts stocks and what investment approach might make sense in the different stages?
Absolutely. So maybe let's take those one by one. So expansion is almost a bit like a markup phase where investor sentiment starts to shift from a neutral to really a more optimistic one. This is usually a phase where the economic growth starts to improve, earnings improve as a result, and confidence tends to grow. As more people start to invest, especially those chasing growth stocks, the market tends to pick up speed. Now, early in this phase, value stocks often tend to lead, but as the rally strengthens, growth and cyclical stocks also start to gain momentum. Now, there might be some short-term dips along the way, but this is also when a buy-the-dip strategy can work well. Since spending tends to be one factor, strong spending is one factor in this phase, sectors such as financials or consumer discretionary usually perform well during this phase. Now, the second one is the distribution phase. Valuations start to look a little more stretched. Market sentiment gets more divided. Some investors are hopeful, others more cautious, and economic data and earnings start to be more mixed. So uncertainty tends to rise, and volatility also tends to start to rise. Value investors begin to slowly exit, and the usual buy the dip strategy may not work as well if markets are not hitting new highs. So this is a phase where sectors such as utilities and healthcare tend to hold up reasonably well. Now, third is the contraction phase. This is when markets start to head down and panic starts to set in among some investors. Earnings tend to be weak and bad economic news tends to worsen sentiment. And this growing fear tends to exacerbate the market sell-off. Some investors at this stage may start to pull out amid a bit of fear to avoid bigger losses, and margin traders may be forced to sell. And it's a phase when speculative, low quality, or the most overvalued stocks tend to be the hardest hit. To be honest, when panic hits, almost everything drops, no matter how strong a company might fundamentally be. So during this phase, sectors like consumer staples and healthcare tend to hold up much better than most. And finally, the fourth phase is the accumulation phase. This often comes right after the market hits its lowest point, or in other words, the trough. It's possible there might be more low lows, so it's always difficult to see if the worst is really behind us. But gradually, as panic and anxiety starts to cool, institutional investors tend to start buying again, and confidence starts to return. Volatility becomes a bit more range bound, and sentiment starts to become a bit more neutral. This is a phase where contrarians, value seekers really start to bargain hunt and look for quality, until, of course, the number of optimists start to outnumber the pessimists, and you sort of start the next cycle. I think big picture, when you think about these four phases, the key lesson is, look, it's very hard to completely avoid market cycles and their impact on a portfolio. But of course, making a few of the smarter choices and being aware can really help you avoid some of the worst losses.
Okay, so that gives us a good stylistic understanding of market cycles, volatilities, investors in sentiment, and how they sort of interact with each other, I guess. I guess, with clients that we speak to on a daily basis, obviously people are worried about trying to hedge their portfolios and manage that risk and volatility. So can you give us an idea about how you might do that from a sector perspective, and just sort of think about how some of the key themes and sectors that people could consider to insulate their portfolio during uncertain market timings?
Absolutely. And I think taking a sector based approach and sort of having an understanding of how each sector behaves during these different phases of the market does help. Lead you to a more well-balanced portfolios. So during an expansion phase, we generally favor cyclical sectors such as more manufacturing, materials, retail, financial services. These are sectors that usually see much more substantial gains when the economy is expanding. Now, as the cycle matures, it's often quite an attractive idea to shift out of these cyclical sectors and start rotating more towards defensive sectors such as consumer essentials, healthcare, and utilities, because these are the sectors that tend to hold up better during market downturns. I think these are, of course, cyclical and more defensive, but there's also, regardless of which phase we're in, I think it always is attractive exposure to somewhat more neutral sectors, if one can call them that, such as technology or telecom, because these sectors tend to do well during expansion. And what we experience more in more recent cycles is that losses can also be more well contained compared to more cyclically sensitive sectors during downturns.
Okay, so this concept of sector rotation, I guess, is interesting just to delve in a little bit more. So obviously, to try and, I guess it's coming into timing some of the market cycles. So can you break it down a bit and share how investors might actually apply this in reality during their investment journey?
Absolutely, and I think the big picture goal, I think that context which is good to be aware of, is that the goal is, of course, to generate better than average returns across market phases. And one approach we'd favor is taking more of a top-down approach to implement this sort of sector rotation strategy. So, in terms of steps, the first thing we do is try to figure out where we are in economic cycle. And this is where a few key macroeconomic indicators like inflation, GDP growth, monetary policy can help. So, for example, if we have strong GDP growth, rising inflation, low policy rates, that's a combination that can signal we're in the expansionary phase of a cycle. The second step is then to identify sectors with potential, because while each market cycle has its own twists and turns, some patterns do tend to repeat. So, for example, as we discussed earlier, a sector like consumer discretionary can do well in an expansionary phase and utilities during a contractionary phase. And finally, the last step, of course, is having done this sort of analysis, it makes sense to review and monitor closely, because at times the scene may not play out quite as desired, and might make sense to reassess, some of the sector-specific factors, because broad brush trends are one factor, but you do get some key differences across different cycles. The last thing I'd say is, look, it always pays attention to stay alert to risks, because broad sector brush cycles are one thing, but regulations do change, consumer preferences do shift, and we have supply chain disruption. So these are more specific factors to pay attention to in addition to the broad cyclical ones.
Yeah, actually, I want to stay on the topic of risk. I guess one of the sayings is that history doesn't repeat, but it rhymes, right? So we should remember that nobody has perfect foresight where we are in the cycle, and therefore whatever we do should be tweaks to allocations rather than an all or nothing approach to investing in different sectors, which obviously can be very volatile. I guess the second point on risk, I guess how do we measure it is really important as well. So I guess the most common measure is the VIX index, also known as the fear gauge, because it sort of gives an indication of how nervous the market is at any given point in time. Can you just give us a quick overview about what the VIX index is and how it may help investors spot economic turning points?
Sure. So I think the way you framed it as a fear gauge maybe is one good way to think about it. Now, specifically the VIX index, it tracks real-time price swings for the S&P 500 index options. So it's one way to think about, or how much uncertainty investors are feeling in the market. And unsurprisingly, the VIX usually moves in the opposite direction to the S&P 500. Now, I think history can sort of help illustrate how much this index, the VIX index, can move at times of major stress. So if you go back to 2008, the VIX index spiked to around 60 as panic spread after the collapse of major firms like Lehman Brothers and the stress on AIG. In early 2020, when COVID-19 hit, the VIX index shot above 80. So that's two examples to illustrate how fearful markets were at the time. Now, as those risks started to calm down, the VIX obviously returned back to lower levels in the region of 10 to 20. So the VIX is what that history shows us, that the VIX is good at capturing current market worries, but of course it's not necessarily always predictive in nature in terms of what might come next. But we use it in combination with other indicators that can be more forward-looking. It can really help with some of the sector rotation strategies we discussed earlier, and help prepare you for what might be bigger market swings in either direction.
Okay, I want to sort of stick on this volatility point because, I guess the point that I think maybe people in today's environment might be forgetting is that volatility is absolutely normal. It's inevitable. You don't know when it's going to exactly hit, but it will come through. But the key is to try and use it to your advantage rather than something to panic about, right? So I guess, how would you look at it from that perspective and say, give some practical tips on how people can navigate market volatility with that confidence?
Absolutely. I think navigating market volatility is really about managing your emotions and making sure they don't come in the way of your investment decisions. And to your point, I think a few practical tips help sort of build a structured approach on how to do this. I think the first thing we'd always suggest is make sure you have enough liquidity to cover emergencies or unexpected expenses. I think that really helps ensuring you're not in a position where you're forced to sell investments when markets face a bout of volatility. Second is, of course, the importance of spreading equity investments across different sectors and other asset classes, of course, like bonds and real estate, to build a more well-rounded portfolio. That way, if one asset class does see a downturn, that can be, other asset classes and sectors can help offset. Uh, Third is we'd recognize that, look, everyone does have a different risk threshold. So it makes sense to really have a realistic assessment of your own risk appetite and then, ensure that the portfolio stays within that. And I think part of that is really about also resisting the urge to chase returns that don't generally match your comfort levels. Fourth is, look, we recognize that market ups and downs are normal, especially when in the short term. But the key here is to keep a laser focus on the long-term goal, be patient, and to some degree avoid overreacting to daily headlines. Warren Buffett, one of his more popular quotes, there are many quotes out there, but one I particularly like is, the stock market is a device for transferring money from the impatient to the patient. So, of course, we'd all rather be the patient one. The key, of course, is to keep investing and, more importantly, to not only get invested, but stay invested during tough market conditions. So that means by continuing to invest, particularly in market downturns, you can take advantage of buying equities, but at lower prices. And finally, when sometimes market declines create an opportunity to buy quality investments at a discount. So it makes sense to stay alert for these opportunities, but of course, within the context of that long-term plan, which always has to be the overall framework.
Yeah, absolutely. I guess how you manage volatility. I mean, it's in times like today, it's pretty easy to make money, I guess. When things get a bit more volatile, the news flow is very much negative. Everybody's shouting at you to sell. Your heart is telling you to sell. But it's really the way I sort of think about this is stepping out of yourself and saying, what would you in 5 years like you to do today, rather than what you tomorrow wish you'd done today. And I think that framing of different time horizons can be really helpful and sort of take you away from the emotional risks and mistakes that you might make. Okay, Manpreet, thanks so much for sharing your insights today. With that, we've obviously come to the end of the episode. We'd like to thank all of our listeners for tuning in today. If you'd like to learn more on how you can navigate equity market volatility, please visit the link in the podcast description. And we hope to see you again soon. See you then. Take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.